Preparing for a corporate banking at JPMorgan Chase Co interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does the corporate banking team do at JPMorgan Chase? Corporate banking sits at the center of the client relationship for large corporations. I would describe it as combining lending, risk management, treasury services, and access to capital markets. At JPMorgan, the banker understands the client's strategy, balance sheet, liquidity needs, and financing plans, then coordinates with partners across payments, markets, and investment banking. The role is commercial, analytical, and relationship-driven, with credit discipline always running underneath. While answering, focus on relationship coverage, credit origination, treasury solutions, capital markets coordination, and the difference between corporate banking and pure investment banking execution. Question 2. Why do companies maintain revolving credit facilities if they may not fully draw them? A revolver is mainly a liquidity backstop. A company may use it to support commercial paper, manage seasonal working capital, or provide confidence during market stress. Even if the facility is undrawn, the bank has committed capital and must underwrite the borrower's ability to repay if it is drawn. The company pays a commitment fee for that availability. For JPMorgan, this also deepens the relationship and creates opportunities around treasury, markets, and debt capital markets. Make sure to cover liquidity insurance, commercial paper backup, seasonal working capital, rating agency comfort, commitment fees, and why banks still analyze exposure even if undrawn. Question 3. Walk me through how you would assess the credit quality of a corporate borrower. I would start with the business model, revenue drivers, cyclicality, competitive position, and industry risks. Then I would move to financials, focusing on EBITDA, free cash flow, leverage, interest coverage, liquidity, and debt maturity schedule. I would also evaluate management credibility and access to capital markets. Finally, I would run downside cases to test whether the borrower can service debt under stress, because credit analysis is ultimately about repayment capacity, not just current performance. In your answer, talk about business risk, financial risk, cash flow stability, leverage, coverage ratios, industry outlook, management quality, collateral where relevant, and downside scenarios. Question 4. How would you explain the difference between corporate banking and investment banking? Be sure to mention client coverage overlap, lending versus advisory, recurring relationship management, capital markets collaboration, risk ownership, and how both teams work together on large clients. Question 5. What are the 3 financial statements, and which one matters most for credit analysis? The income statement shows profitability, the balance sheet shows financial position, and the cash flow statement shows actual cash generation and use. For credit analysis, I care most about cash flow, because debt is repaid with cash, not accounting earnings. That said, I would not look at it in isolation. The balance sheet tells me leverage and liquidity, while the income statement shows margin trends and operating performance that drive future cash flow. While answering, explain the income statement, balance sheet, and cash flow statement. Then emphasize cash generation, debt obligations, liquidity, and reconciliation across statements. Question 6. If revenue grows but cash flow declines, what could be happening? One common reason is working capital. If sales rise but customers take longer to pay, accounts receivable can grow faster than revenue, reducing operating cash flow. Inventory build or higher supplier prepayments can have the same effect. Cash flow could also decline because of margin pressure, higher capex, taxes, or restructuring costs. As a lender, I would investigate whether growth is healthy or whether the company is stretching working capital to support reported revenue. Make sure to cover working capital absorption, receivables growth, inventory build, lower margins, capex, one-time items, aggressive revenue recognition, and why lenders investigate quality of earnings. Question 7. How do you think about leverage and interest coverage for a corporate client? Leverage tells me how much debt the company carries relative to earnings, often debt to EBITDA. Interest coverage tells me how comfortably earnings or cash flow covers interest expense. I would compare both ratios against peers, rating category norms, and the client's own history. A stable utility can support more leverage than a cyclical industrial company. I would also look at debt maturities, liquidity, and covenant headroom because ratios alone do not capture refinancing risk. In your answer, define leverage and coverage, explain industry context, cash flow consistency, rating implications, debt maturity profile, and why ratios must be interpreted with business risk. Question 8. What factors influence the pricing of a corporate loan? Loan pricing reflects the borrower's credit risk, facility tenor, structure, collateral, and market conditions. A stronger borrower with stable cash flow and investment-grade ratings should receive tighter spreads than a highly levered borrower. The bank also considers capital usage, expected return on risk-weighted assets, undrawn commitment exposure, and relationship value. At a place like JPMorgan, pricing must be competitive, but still meet risk-adjusted return hurdles and compensate the bank for committed capital. Be sure to mention borrower credit risk, tenor, collateral, market conditions, relationship economics, regulatory capital, expected utilization, fees, syndication risk, and competitive dynamics. Question 9. What is a covenant, and why do banks use covenants in corporate lending? A covenant is a contractual promise in a loan agreement. Affirmative covenants require the borrower to do certain things, like provide financial statements. Negative covenants restrict actions, such as taking on excess debt or selling major assets. Financial covenants test metrics like leverage or interest coverage. Banks use covenants to monitor risk and create early intervention points before default. Good covenants protect lenders while still giving the borrower enough flexibility to run the business. While answering, distinguish affirmative, negative, and financial covenants. Explain early warning signals, lender protections, borrower flexibility, and negotiation around covenant levels. Question 10. How would you prepare for a client meeting with a CFO of a Fortune 500 company? I would prepare by reviewing recent earnings, investor presentations, debt maturities, credit ratings, liquidity position, and major strategic initiatives. I would also understand JPMorgan's existing relationship, lending exposure, treasury services, markets activity, and recent capital markets transactions. Then I would identify 2 or 3 relevant discussion points, such as refinancing opportunities, working capital efficiency, or hedging needs. The goal is not to recite facts. It is to bring informed, practical ideas to the CFO. Make sure to cover company research, recent earnings, capital structure, liquidity, industry trends, strategic priorities, existing JPMorgan relationship, thoughtful questions, and actionable ideas. Question 11. A client's EBITDA falls 25% and leverage rises above the covenant limit. What would you do? First, I would understand whether the EBITDA decline is temporary, cyclical, or structural. Then I would assess liquidity, cash burn, covenant headroom, and upcoming maturities. If a breach is likely, the bank may discuss a waiver, amendment, pricing increase, tighter reporting, or additional protections. I would escalate internally through credit and risk while staying constructive with the client. The objective is to protect the bank's position without damaging a long-term relationship unnecessarily. In your answer, talk about understanding causes, liquidity analysis, covenant breach process, waiver or amendment, revised forecast, risk escalation, relationship management, and protecting the bank. Question 12. What is a syndicated loan, and why would JPMorgan arrange one? A syndicated loan is a facility provided by a group of banks rather than a single lender. For a large borrower, it provides access to more capital and diversifies bank relationships. For JPMorgan, arranging the syndication allows the bank to support a major client while managing concentration risk and earning fees. The lead arranger structures the deal, negotiates terms, underwrites part of the facility, and distributes portions to other lenders. Be sure to explain multiple lenders sharing exposure, arranger role, borrower benefits, distribution risk, fees, relationship value, and why large facilities are not kept by one bank. Question 13. How do rising interest rates affect corporate banking clients? Rising rates increase interest expense for floating rate borrowers and can pressure interest coverage. They also make refinancing more expensive and may reduce appetite for acquisitions or capex. Some clients may need hedging solutions such as swaps to manage rate exposure. Higher rates can also change deposit behavior and liquidity planning. The impact depends on sector, leverage, and cash position. A cash-rich company may benefit, while a highly levered borrower may face real stress. While answering, cover higher borrowing costs, interest coverage pressure, refinancing risk, deposit behavior, hedging demand, working capital impact, valuation effects, and sector-specific differences. Question 14. What is the role of Treasury services or payments in a corporate banking relationship? Treasury services help companies move, manage, and optimize cash. That includes collections, disbursements, liquidity structures, foreign exchange payments, and working capital solutions. In corporate banking, payments are powerful because they solve daily operational problems, not just episodic financing needs. For JPMorgan, wholesale payments are a major strength and create sticky relationships. A lender may interact with a client occasionally, but a payments bank can be embedded in the client's daily operations. Make sure to mention cash management, liquidity optimization, collections, disbursements, cross-border payments, operating deposits, client stickiness, and JPMorgan's strength in wholesale payments. Question 15. How would you evaluate whether a bank should increase exposure to an existing corporate client? I would first reassess credit fundamentals, recent performance, leverage, liquidity, cash flow, and outlook. Then I would ask why the client needs more exposure, whether it supports a sound business purpose, and how repayment will occur. I would also evaluate JPMorgan's total relationship, including deposits, payments, markets, and capital markets opportunities. The answer should balance client franchise value with disciplined risk management, concentration limits, pricing, and documentation protections. In your answer, discuss updated credit performance, strategic importance, wallet opportunity, risk-adjusted return, concentration limits, facility purpose, documentation protections, and downside risk. Question 16. What would you include in a credit memo for a corporate borrower? A strong credit memo tells the full repayment story. I would include the company overview, business model, industry position, management assessment, historical financials, projections, leverage, liquidity, and debt maturity profile. I would clearly state the facility purpose, structure, pricing, covenants, and collateral, if relevant. Most importantly, I would highlight key risks and mitigants, then explain why the proposed exposure is acceptable or not acceptable from a credit perspective. Be sure to cover company overview, industry analysis, management assessment, financial performance, projections, debt structure, sources and uses, risks, mitigants, covenants, and recommendation. Question 17. How do regulatory capital and risk-weighted assets affect corporate banking decisions? Banks cannot look only at loan spread, they must consider capital consumption. Higher risk exposures generally create higher risk-weighted assets, which require more regulatory capital. That capital has a cost, so the bank measures whether the relationship produces an acceptable, risk-adjusted return. A low-spread revolver to a strong client may be justified by broader relationship revenue, but every commitment still uses balance sheet capacity. This is why pricing, structure, and cross-sell matter in corporate banking. While answering, explain that committed lending consumes capital. Higher-risk borrowers require more capital, returns are measured on capital, and pricing must reflect regulatory and economic costs. Question 18. Tell me about a time you had to manage multiple priorities under pressure. I would answer with a clear star example. For instance, during a finance project, I had to complete a valuation model, prepare a presentation, and respond to last-minute data changes. I prioritized the deadline-critical items, clarified expectations with teammates, and built a quick quality control checklist to avoid errors. The result was an on-time submission with accurate analysis. I would connect that to corporate banking, where client requests, credit work, and internal approvals often move simultaneously. Make sure to use a concise star structure. Show prioritization, communication, attention to detail, ownership, and connect the example to the pace of JPMorgan corporate banking. Question 19. Why JPMorgan Chase for corporate banking? JPMorgan is compelling because it combines scale, product depth, and disciplined risk culture. In corporate banking, that matters because clients need a bank that can lend, advise, move money globally, access markets, and stay reliable through cycles. I am especially drawn to the integrated corporate and investment bank platform and the strength in payments. The firm's fortress balance sheet reputation also signals long-term commitment, which is exactly what large corporate clients value. In your answer, mention JPMorgan's global franchise, fortress balance sheet, leading corporate client base, integrated corporate and investment bank platform, payment strength, training, and risk discipline. Question 20. If a corporate client asks for a lower loan spread, how would you respond? I would not respond with an immediate yes or no. I would first understand the client's rationale, competing quotes, and broader relationship context. Then I would evaluate whether the requested spread still meets risk-adjusted return requirements after considering credit risk, tenor, capital usage, and expected ancillary business. If needed, I might propose trade-offs such as adjusted fees, structure, utilization, or broader relationship commitments. The key is to be commercially responsive while protecting the bank's economics. Be sure to cover relationship approach, benchmarking, credit risk, capital return, broader wallet, internal approvals, trade-offs, and maintaining professionalism without immediately conceding economics. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.